Conventional wisdom says cash is safe. But over the long run, it's one of the riskiest assets you can hold. Vanguard's 1901 to 2022 global data shows cash-like returns average about 2.9% annually, while stocks return around 8.1%. The real risk is not volatility, it's losing purchasing power. Most people think that putting money in a bank or a money market fund is the safest possible move. After all, the principal doesn't fluctuate, and you get a small interest payment. But safety has a hidden cost. It's the slow, silent erosion of your purchasing power. When inflation runs higher than your interest rate, your money actually loses value every year. This is the illusion of safety, the belief that avoiding volatility protects you, when in reality it exposes you to a different, more insidious risk. To understand the real risk, we need to separate nominal returns from real returns. The nominal return is what you see on your statement. The real return is what you can actually buy with that money after inflation. The formula is simple: real return equals 1 plus the nominal return, divided by 1 plus the inflation rate, minus 1. If your nominal return is 2% and inflation is 3%, your real return is negative, you're losing purchasing power. Now let's compare the long-term performance of cash and stocks. According to Vanguard's study of global markets from 1901 to 2022, an allocation with no stocks at all returned about 2.9% per year on average. In contrast, stocks, despite multiple crashes, returned about 8.1% per year. That's a gap of over 5 percentage points. Over 20 years, the difference is enormous. The key point is that stocks' higher returns come with volatility, but over long horizons, that volatility is rewarded. This bar chart shows the average annual returns from Vanguard's 1901 to 2022 study. The cash-like allocation returns about 2.9% per year, while stocks return about 8.1%. The difference is stark. But remember, these are averages. Stocks had years with losses of 30% or more, but they also had years with gains of 50%. Over decades, the compounding effect of higher average returns dominates. Let's talk about inflation. Inflation is the general increase in prices over time. If you have $100 today and inflation is 3% per year, you need $103 next year to buy the same goods. Cash and money market funds often pay interest below inflation, especially after taxes. So even if your nominal balance grows, your real purchasing power shrinks. Over 20 years, that erosion can be devastating. The safe asset is quietly making you poorer. The gap between 2.9% and 8.1% might not seem huge, but compounding makes it enormous over time. The future value formula shows how an investment grows. Future value equals present value times 1 plus the return rate, raised to the number of years. For example, $10,000 at 2.9% for 20 years grows to about $17,700. At 8.1%, it grows to about $47,300. That's a massive difference in purchasing power. Let's imagine a conversation between an investor and a financial advisor. The investor says, "I want to be conservative, so I keep all my money in cash." The advisor responds, "But cash loses purchasing power to inflation. Are you willing to accept a guaranteed loss in real terms?" The investor says, "But stocks are risky, they can crash." The advisor explains, "Stocks do crash, but over 20 years, they've always recovered and grown. The risk of not investing is that you outlive your money." There are two types of risk: volatility and purchasing power risk. Volatility is the short-term ups and downs in the value of an asset. Purchasing power risk is the long-term erosion of your money's buying power due to inflation. Many people focus on volatility because it's visible and scary. But over a 20-year horizon, purchasing power risk is far more dangerous. A 50% stock market drop might recover in a few years, but a 3% inflation rate that persists for 20 years cuts your purchasing power in half. This line chart illustrates the growth of $10,000 over 20 years at different annual returns. The blue line shows cash-like returns at 2.9%, ending at about $17,700. The orange line shows stock returns at 8.1%, ending at about $47,300. The gap widens dramatically over time. This is the power of compounding. Even a small difference in annual return becomes a huge difference in wealth. Let's quantify the cost of being too conservative. The difference in future value between a cash-like allocation and a stock allocation is the opportunity cost. Using our earlier example, the difference is about $29,600 over 20 years. That's the price of safety. And that's before considering taxes and inflation. The formula for opportunity cost is simply the future value of the higher return investment minus the future value of the lower return investment. In finance, conservative often means preserving capital and avoiding risk. But true capital preservation should consider real purchasing power, not just nominal value. A conservative investor might be better off with a diversified portfolio that includes some stocks, even if it means accepting short-term volatility. The goal should be to maintain or grow purchasing power over time. That's the real definition of safety. So, is cash safe? Over short periods, yes. Over long periods, no. The data from Vanguard's 1901 to 2022 study is clear. Cash-like returns average about 2.9% annually, while stocks return about 8.1%. Inflation silently erodes cash's purchasing power, making conservative, cash-heavy strategies the riskiest bet for long-term wealth. The real risk is not volatility, it's the certainty of losing purchasing power. If you're investing for the long term, consider a diversified portfolio that includes stocks. Your future self will thank you. We'd love to hear your thoughts. Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.